Less than 48 hours after IMF did project global growth to taper down to 3.7% due to trade tensions and is worried about crude oil prices as far as India is concerned, I have with me IMF's chief economist, Professor Maurice Obstfeld, speaking to us right here in the summit in Bali, Tweety now. Thank you very much, Mr. Professor, for being with us. Global growth is likely to taper down to levels of 3.7% from 3.9% owing to global trade tensions. Should the world brace up for a full-blown trade war, and are these figures likely to go down even further? You've been on record to say we could see a cut of nearly 1 percentage point if things were to continue like this.
Well, we see downside risks that have intensified. Our likely forecast for 2019, as you said, is 3.7%, which, by the way, is the same as it is in 2018 as in 2017. So this is a plateauing of growth rather than a big reduction of growth. Right now the big conflict in trade seems to be between the U.S. and China. And of course, these are the world's two biggest economies. If they are at odds with each other, that's something that's not going to be good for anyone. But how much escalation there will be remains to be seen.
If there were to be escalation, and obviously it's moved beyond the rhetoric, US has fined almost half of China's imports. China's responded in a similar fashion, putting an import tariff on about $110 billion worth of US imports. If this were to escalate, by when will it start hurting both the US and the Chinese economy themselves? There has to be a time in this trade war when it begins to impact economies that are resorting to protectionism, won't it?
Well, our forecasts for 2019 already incorporate the tariff measures that have been put in place. And indeed, they lead to a reduction in growth in China, in the US, and spillovers of those growth effects to countries throughout the world, particularly in Asia. So we think the effects are going to be felt in 2019 of the measures that have already been taken, and of course if further measures are taken, the effects will be felt pretty quickly.
The IMF projection talks about the emerging market currency carnage of sorts that we are seeing. Our own rupee has been at the receiving end of this. I know a lot of it has to do with the strengthening dollar and the outflows from the emerging markets, but how deep is this pain going to be, and how much longer is this going to last as far as emerging market currencies are concerned, the contagion as it's being called?
Well, we are seeing a tightening of financial conditions and a strengthening of the dollar. This started setting in about 6 months ago at the time of our spring meetings. And at the moment, the Fed is certainly going to continue raising interest rates. We're looking for another increase in December. And some of this pressure is coming from U.S. fiscal policy, which is a pro-cyclical policy. It's increasing the U.S. deficit at a time of basically full employment. This isn't going to go on forever because we are projecting that fiscal policy in the U.S. will go into reverse by 2020, and markets will begin anticipating this. So, continuing, anticipating, strengthening, intensifying pressure on emerging markets. Probably not a very long-term phenomenon, but for now, financial conditions are tightening.
Financial conditions are tightening, and if I may speak to you specifically about India, the liquidity tightening that you've raised the red flag on, besides oil prices, obviously has a lot of people worried, because as far as the Indian rupee is concerned, it's the worst performing among its Asian peers. It has had a downward spiral for a while now. The fact is that our macros are not as vulnerable as some of the other emerging markets are. What do you then attribute this pain to? And of course, there's a larger vulnerability that India is seeing on the current account deficit front as well.
Yeah, I mean, India's current account deficit is rising. It's forecast to be around 3% of GDP. But remember, India is particularly exposed to the oil market, and that's been a very, very big factor in the recent depreciation of the rupee. So this is, to some extent understandable. And remember, the depreciation against the dollar is much bigger than the effective depreciation against all trading partners.
That's right.
Again, this is in part a dollar story. And I think over this year, the rupee's effective depreciation is more like 4%. So that is not a dramatic fall.
You're bullish on India, and you say that GST and IBC are good reforms, but you flag off land and labor as reforms that India will need to go into the other orbit, to go into the higher growth trajectory. How hopeful are you of those reforms happening? Because we are entering a phase where general elections are less than 12 months away. These are politically sensitive decisions to be taken, and if those weren't taken, will our growth plateau at these levels as well?
Oh, our growth forecast for India is for 7.3% this year, 7.4% next year. Those are very healthy growth rates, and up from the previous growth rate of 6.7%, which reflected the sort of disruptions of demonetization, the sort of bumps in the road in introducing the GST. Our forecast is that growth in the medium term will rise even higher, and that reflects reforms that have been put in place already, including the IBC, the GST. Election times are always challenging times for structural reforms, but India is very firmly on the reform path, and if this continues, growth can accelerate.